Are you considering investment options with the US stock market? Then this video here is for you. Let us tell you why minimizing your bets on the US stock market is going to be beneficial for you. From factors like lower yields, higher taxes, complex state tax issues, to concerns about asset confiscation, keep watching as we tell you what to anticipate in your investment approach. The decision to minimize exposure to the US stock market is underpinned by an evolving investment landscape that demands a nuanced approach. One crucial aspect of this strategic shift is the recognition of the lower yields prevalent in the US market, particularly in comparison to international counterparts. The financial sector, exemplified by banks like Wells Fargo and Bank of America, may offer yields around 3%, while robust banks in countries like Singapore, such as the Overseas Chinese Banking Corporation or OCBC, present yields of approximately 6%. This yield discrepancy not only impacts immediate returns, but also influences the long-term growth potential of investment portfolios. Moreover, the intricate web of taxation adds a layer of complexity for non-US investors. The global tax reach of the United States, taxing both its citizens and foreign investors, necessitates careful consideration of the tax implications on dividends. Even in tax-friendly jurisdictions, the absence of comprehensive tax treaties can result in higher dividend withholding taxes, affecting the overall return on investment. This tax burden is further compounded by state tax issues, where varying tax regimes across states create additional challenges for investors navigating the US stock market. Estate planning becomes a critical aspect of investment strategy due to the US estate tax, which poses potential challenges for non-US investors holding US stocks. Beyond the federal estate tax, state-level estate taxes vary, adding an additional layer of complexity to the overall tax planning process. Successful management of these tax considerations requires a holistic approach involving structures such as trusts and corporate entities to optimize tax efficiency and protect the estate from undue tax burdens. Diversification emerges as a key strategy in response to these challenges, advocating for a balanced portfolio that extends beyond the confines of the US stock market. This approach involves spreading investments across different countries, industries, and asset classes to mitigate risks associated with market volatility. The pursuit of global opportunities becomes integral to this strategy, enabling investors to capitalize on the strengths of various regions and industries, thereby enhancing the resilience of their portfolios. For non-US investors seeking alternatives, strategic options exist to navigate the complexities associated with the US stock market. S&P 500 index funds domiciled in countries with favorable tax conditions offer a potential avenue for exposure to the US market while optimizing tax efficiency. Additionally, exploring opportunities in emerging markets or sectors with strong growth potential provides alternative avenues for diversification, allowing investors to balance risk and reward effectively. Platforms like nomadcapital.com play a pivotal role in supporting investors through this intricate decision-making process. By offering resources and assistance in setting up investment structures, connecting with global tax experts, and navigating the complexities of investing in different jurisdictions, these platforms empower investors to make informed decisions aligned with their financial goals and risk tolerance. The emphasis on collaboration with international experts underscores the recognition that successful global investments require a comprehensive understanding of local regulations and tax frameworks. The decision to minimize bets on the US stock market is not a singular response to financial metrics, but a holistic approach that considers various factors. From lower yields and complex tax implications to concerns about asset confiscation and the pursuit of global opportunities, investors are navigating a complex landscape that demands strategic thinking. This paradigm shift reflects a broader evolution in investment philosophy, where diversification, risk management, and a global perspective redefine the traditional boundaries of market-centric approaches. Investors worldwide often view the US stock market as a cornerstone of their investment portfolios, given its historical resilience and the presence of renowned companies. However, a growing sentiment among certain investors suggests that minimizing exposure to the US stock market might be a strategic move. This perspective is rooted in a nuanced understanding of various factors, ranging from financial considerations to broader geopolitical and taxation issues. In exploring these reasons, individuals can make informed decisions about portfolio diversification and risk management. One of the primary considerations driving the inclination to minimize bets on the US stock market is the observation of lower yields, particularly in sectors such as finance. A comparative analysis with international counterparts, like Singapore's robust banking sector, reveals higher yields that contribute to more attractive returns. For instance, iconic US banks like Wells Fargo and Bank of America may offer yields around 3%, whereas banks in other countries, such as the Overseas Chinese Banking Corporation in Singapore, present yields of around 6%. This discrepancy underscores the importance of exploring opportunities beyond the US market to enhance the overall yield of an investment portfolio. Tax considerations form another critical aspect leading investors to reconsider their exposure to the US stock market. Non-US investors face distinct challenges, particularly in the realm of dividend taxation. The United States taxes its citizens on global income, and this extends to foreign investors, irrespective of their place of residence. Even in tax-friendly jurisdictions, such as the United Arab Emirates or UAE, the absence of tax treaties can result in higher dividend withholding taxes for non-US investors. Navigating this complex tax landscape becomes crucial for individuals seeking to optimize their investment returns and minimize the impact of taxation on dividends. Beyond federal taxes, investors need to grapple with state tax issues and the US estate tax. State tax regimes vary, adding an additional layer of complexity to investment planning. Furthermore, the US estate tax poses a potential challenge for non-US investors holding US stocks. Upon an investor's demise, their US assets may be subject to estate tax, which can be considerably high. Navigating these intricacies requires careful planning and consideration of various structures such as trusts and corporate entities to mitigate the impact of state taxes and estate taxes on the overall investment portfolio. In a more abstract realm, concerns about asset confiscation contribute to the rationale for minimizing bets on the US stock market. The fear is that larger nations, particularly the US, might adopt a more aggressive approach to asset appropriation, posing risks to investors. This consideration aligns with a broader philosophy of seeking asset protection in jurisdictions that prioritize the safeguarding of capital and innovation. Investors exploring international opportunities increasingly view geopolitical factors as crucial elements in their decision-making process. The call to minimize bets on the US stock market is intertwined with a broader strategy of diversification and the pursuit of global investment opportunities. The belief is that various regions offer unique advantages, both in terms of returns and risk management. Diversifying across countries, industries, and asset classes allows investors to capitalize on different economic cycles and mitigate risks associated with over-reliance on a single market. This strategy aligns with the core principles of risk management and portfolio optimization. For non-US investors seeking alternatives, strategic options exist. S&P 500 index funds domiciled in countries like Ireland and traded on international stock exchanges provide avenues for exposure to the US market with potential tax advantages. Such funds can offer reduced dividend withholding taxes and mitigate the complexities associated with direct ownership of US stocks. Additionally, exploring opportunities in emerging markets or sectors with strong growth potential becomes a viable strategy for those looking beyond the traditional confines of the US market. Investors are displaying an unwarranted confidence in the Federal Reserve's inclination to cut interest rates this year, potentially exposing themselves to future consequences, as suggested by asset management giant BlackRock and other Wall Street experts. Market indicators indicate an expectation for the Fed to maintain its benchmark interest rate at current levels, with potential reductions commencing as early as July, reaching a possible full percentage point decrease by year-end, according to CME Group calculations. This outlook contrasts with public statements from central bank officials who, in their unofficial forecast, highlighted the likelihood of another quarter percentage point hike with no cuts at least through 2023. BlackRock contends that the anticipation of rate cuts aligns with recession assumptions, driven by a fall in inflation, which the firm views as dubious in the current economic context. Contrary to market sentiment, BlackRock is underweight on stocks in developed markets like the US and advises clients to focus on inflation-indexed fixed income investments and short-duration government bonds. The firm suggests that the prevailing resilience in stocks is rooted in the hope that the Fed will ease after a period of tightening. However, BlackRock strategists argue that the Fed would only implement the anticipated rate cuts if a severe credit crunch triggers a deeper recession than anticipated. Despite the Fed's projections implying a shallow recession, analysts note the paradox of investors expecting both a more accommodative Fed to combat economic slowdown and a continuation of stock market gains. Bank of America concurs with BlackRock, advising clients to bet against U.S. stocks and adopt strategies that benefit from market downturns. The overarching concern is that investors may be overlooking the historical correlation between recessions and negative equity performance, emphasizing the importance of a nuanced approach to market dynamics. What are your investment strategies? Comment below and do not forget to like, share, and subscribe to this channel before you leave.